feel enormously grateful. We feel very humbled also by that honor. I can tell you that everybody on the team wakes up every day wanting to perform for clients and to do their best, in part because this past year has been one of the worst years over almost the last 20 years for performance of those types of companies. So profitable companies we think will do better. We start with the philosophy. So we do not employ a top-down approach when we construct the portfolio. We don't start the year by trying to make predictions about interest rates, about government policy, about themes necessarily. So we don't sit there and say, well, we think AI will be more important next year than this year. Let's just buy AI-focused companies. It really is based on a bottoms-up assessment of the profitability of the company, their ability to reinvest, and the price they're trading.
Thank you for having me today again. I'd like to start with the popularity of Bernstein U.S. growth strategy in Japan. So, as you know, the U.S. growth stock strategy you oversee is also offered in Japan and is widely recognized as having the largest AUM among active funds in Japan. To begin, how do you feel about its popularity in Japan?
Well, first off, thank you for coming and speaking with me. We feel enormously grateful. We feel very humbled also by that honor. I can tell you that everybody on the team wakes up every day wanting to perform for clients and to do their best. We take the job as a very serious responsibility. Investors are putting their trust in us. We are very disciplined investors with a very specific philosophy. So it is very gratifying, but very humbling to have that honor.
Thank you so much. And I'd like to reflect on the 2025 market. So 2025 was quite a challenging year for the U.S. stock market, wasn't it? So with Trump tariffs, geopolitical risks, and the shift in the AI boom, U.S. stocks ended up underperforming global stocks throughout the year. Given your experience managing investments on the front lines in the U.S., have you noticed any kind of change or shift in U.S. stocks compared to recent years? Also, what do you anticipate 2026 will be like?
Yeah, it's an excellent question. I think you're right in saying that it certainly has been a challenging environment for the U.S. markets. There have been a few things that we have noticed with U.S. markets that are different from prior periods. The first is that the market concentration issue today is more severe than it has been at any point in its history. So, with the growth index, the top 10 stocks make up nearly 60% of the index. With the S&P, it's close to 40%. Concentration is not unusual. It happens in markets, but it doesn't persist. So there usually are periods where that concentration starts to dissipate and broaden out. But this period is certainly much more severe than prior periods. The other issue that we have observed is that volatility this past year has been a lot higher than historical periods. And, one of the ways to sort of think about that is stocks on disappointing news historically may go down, around 25% or so. More recently, those stock moves have been on the order of, 35, sort of 40%. So very high volatility. The last thing is that the factors that have really driven performance for the U.S. market this year has been centered on higher beta names and higher momentum names. And so to your question about what we think about 26, we do think that quality companies, so companies that have high levels of profitability, very good returns on invested capital, should perform better. In part because this past year has been one of the worst years over almost the last 20 years for performance of those types of companies. So profitable companies we think will do better. We also think it makes a lot of sense for investors to pay attention to the prices they're paying for these businesses. So we think valuations will also matter going forward.
Okay, thank you. I'd like to delve into your investment philosophy next. Even amid such challenges, I believe there is an investment philosophy that has remained consistent throughout your long-standing growth strategy. What is this enduring investment philosophy that you have consistently upheld throughout this period? Or given your extensive experience, have there been instances where you've adjusted your investment philosophy to adapt to changing environments?
Yeah, it's a wonderful question. It is one of the things that defines our team, which is a very strict adherence to a very specific investment philosophy. And our investment philosophy really centers on three key things. The first is we are focused on finding good businesses rather than trying to predict stocks. I think it is very hard to predict whether a stock will be good or bad. We think it is better for long-term investors to think about stocks as businesses and whether a business is a good business or not a good business. The second thing is how we define a good business. Many managers will say they invest in good businesses, but they define it differently for each business. For us, a good business is one that has high returns on invested capital, so they generate a lot of profit and don't need to invest a lot of money in the business. The second is that the businesses are reinvesting, so they're taking their profits and investing it back into the business, and that creates the power of compounding. And then the third is we want to buy them at attractive prices. So we do believe that investors are better served when managers are more price aware. We would agree that these types of businesses that have very high levels of profitability and are investing in themselves aggressively are typically more expensive. But nonetheless, we do think that the price you pay or the discount rate that you get in an investment matters a lot. And so that particular philosophy is something that has been instituted since the team took over the strategy just after 2011 in 2012. The core philosophy has not changed. I do not expect it to change, but given the current environment, we have made some changes around how we construct the portfolio, and that is really focused on making sure that we are broadening out the risk we're taking. So what that means is when you're in a market environment where there is a lot of volatility, you want to make sure that your position sizing for each name is appropriate. You don't want to have such a large position where if the volatility is extreme that you can't react to it. So the two changes we've made are broadening out the risk budget. So our name count this year is higher than it's been historically, and sizing things a little bit smaller so that we can take advantage of the volatility rather than regret the initial sizing.
This kind of current environment, I'd like to ask you about the specific themes that your growth strategy is now focusing on and within your unchanging investment philosophy. Could you please share what sectors you believe will offer significant profit opportunities over the medium to long term?
Sure. The one that I would call out that has sort of been challenged for much of this year would be healthcare. You know, if you go back sort of 2 years to 2023, many investors were wrestling with the question of whether the global economy could handle the impact of higher interest rates. And so they were defensively positioned. And then what happened was that the economy actually held up quite well as rates went up. And that coincided with NVIDIA reporting the quarter that unleashed the AI boom. And that led investors to take a lot more risk. And so healthcare as a sector suffered. And it continued to suffer in 2024 because of concerns about the U.S. election and policy proposals. And then in 25, for the first sort of half of the year, it was quite a good sector as people wrestled with tariff implications and GDP growth. But in the back half of the year until more recently, it suffered quite a bit because the market went risk on again. So we were at a point, and are still very near that point, where if you look at the weight of the healthcare index in the S&P 500, it was at an over 2-decade low. It was below 10%. And historically, those sort of periods have been very good buy signals because the sector doesn't really stay below 10% for too long. The second point is that the policy concerns have been very mild. So there hasn't been a lot of policy changes to healthcare, and we don't expect there to be a lot of disruptive change. So we think the backdrop is quite favorable for healthcare. And then on valuations, because of the underperformance, became much more attractive, where they were below the historical market multiple that the sector has gotten. But really what gets us, I think, most excited is that this sector is likely to be a very large beneficiary of AI. And so if we are in an environment where it takes longer for us to monetize AI, healthcare should benefit as investors become more defensive. If AI really fulfills the promise that we all hope it will, then you can very easily envision a world where we are much better at diagnosing things like cancer more accurately and earlier, where we can use robotics in surgery to improve outcomes and make physicians operate more efficiently. And those will be beneficiaries to many healthcare companies. So healthcare is certainly one area that we are excited by because of the enduring profitability, the innovation that drives the growth, the valuation, and the benign policy backdrop, in our opinion.
I think healthcare stocks doesn't sound like tech stocks and AI stocks. It doesn't seem to be related to AI. But you think it can gain advantage of AI?
Yeah, so I think for AI to be successful, it has to expand beyond just the hyperscalers and the chip companies. So ultimately, AI has to create value for end users and consumers. There actually is quite a lot of innovation happening with respect to AI in healthcare. So there are companies that develop surgical robots that have been in the market for 30 years. And we expect them to use AI to help surgeons do surgeries in a safer way, so that surgeons don't make the same number of mistakes or create complications that can happen. That is a direct beneficiary of AI. There are companies that make X-ray machines and ultrasound machines where AI can help diagnose cancer. There was a study that was done a few years ago where a technology company developed an algorithm to identify cancer off of a CAT scan, off of an image. And they compared their algorithm to about 9 or 10 radiologists. And their algorithm was more accurate in predicting cancer. So the last piece is that AI will likely be used to discover whether or not you can develop drugs faster using AI. And so I do think that healthcare doesn't get enough credit for the potential of AI, but it is certainly something that's being explored in the industry and something that we would expect to be quite beneficial to it over the long term.
Next, I'd like to deep dive into AI, as you mentioned. So among these themes, I'd like to delve deeper into AI, which has, garnered significant public attention. Even amidst discussions of an AI bubble, do you still view AI as the key to future U.S. growth? And Furthermore, while it's true that many AI stocks appear quite overvalued, as you mentioned before, what degree of possibility do you anticipate for an actual air bubble collapse?
Yeah. I think certainly in the near term, the narrative in the U.S. is focused on AI.
Oh.
I think, though, the outstanding question which we are focused on is around understanding the how quickly AI will be monetized. So it's one thing to invest to build data centers and buy GPUs, but that investment becomes more concerning if you can't actually create a lot of profits from it. So the first question is, how profitable can AI actually be? And what we have observed, at least initially, is right now it looks to be profitable in digital advertising. It's a little bit hard to tease out because the economy has done reasonably well, so perhaps digital advertising is doing better because people are buying more things. But it's certainly the case that if you look at many of these companies that are utilizing AI, that their digital advertising business is doing well. The second issue is kind of how does it expand? So what other areas? And over what time frame? For some areas, for example, in healthcare, it may take a long time to use AI to develop new drugs because you have to spend many years testing the drugs, right? So I think the amount of profit and how long it takes to get there are two outstanding questions for AI. Your question about are we in a bubble or not is a very hard one to answer, and every investor probably has an opinion on it, but everyone is going to be wrong, I think, because one, no two bubbles are the same, and it is very hard to time the market. So while it is true that the companies that are driving the growth in AI today are generally much more profitable than the companies that were driving the tech bubble back in the 90s, that doesn't mean that these companies aren't expensive and the valuations can't reset, right? The second point we would make is we're generally more hesitant and reluctant to invest in unprofitable companies. And that's where there might be more risk from all of the enthusiasm around AI. So if it turns out that it's going to take a lot longer, then if you're a company that's not making money, it puts you in a much more difficult position. So I do think there are some companies out there that are likely overvalued because they just say they're doing AI and they're not really doing AI, or because they're unprofitable and they'll need to spend a lot of capital before they can develop a product that they can actually market. But there certainly will be companies that will benefit from AI, that will be successful from it. Our point, though, is that it will be broader than just the tech sector.
Thank you. So it's important to avoid taking exposures too much on AI stocks?
Yeah, we think broadly that diversification is still a principle that matters for investors over the long term. And this year, sort of exemplifies that, to your earlier point about the outperformance of ex-US markets. That doesn't mean that investors should give up on the US, because there are a lot of very interesting things happening with AI, obviously, with the US driving a lot of that growth. And even if you look at profitable companies, the vast majority still sit in the US. But it's very hard to predict which markets will go up or down in any given year, and that's why being diversified, we think, makes a lot of sense. And the same is true for a portfolio. Tomorrow is very hard to predict, but if you have a portfolio of companies that are all very high quality, that are reinvesting, that aren't meaningfully overvalued, I think you have a better chance at being successful over the long term.
Okay. At that point, I'd like to ask the next question about strategy for sustainable growth and risk management in 2026. Considering these key themes and future outlook, how do you plan to focus on sustainable growth companies in 2026? Also, many stocks are still at high valuations. How do you plan to control risk in this environment?
Yeah, no, it's a wonderful question. We start with the philosophy. So we do not employ a top-down approach when we construct the portfolio. We don't start the year by trying to make predictions about interest rates, about government policy, about themes necessarily. So we don't sit there and say, well, we think AI will be more important next year than this year. Let's just buy AI-focused companies. It really is based on a bottoms-up assessment of the profitability of the company, their ability to reinvest, and the price they're trading at. And what we have found, at least going through 2025, is that many companies that aren't so close to the AI theme are trading at attractive valuations, are profitable businesses. They have good long-term prospects, so those are the companies that are likely to be in the portfolio and perhaps even be sized up. The risk part of it has more to do with the market structure and volatility. Because the volatility is much higher, and we believe it'll likely be higher going forward, maybe not to this level, but certainly it'll stay elevated, we think. It just means that we're going to size things more conservatively initially and, like I indicated earlier, kind of increase our name count to adjust for that volatility.
Okay. It's becoming more and more difficult to control risks for individual investors, so I think it's very important to understand the importance of active funds because they are strictly and very carefully selecting stocks. So I think it's very important. Lastly, I'd like to ask your message to Japanese investors. As many of our clients in Japan hold this fund, could you please offer a message to Japanese investors? Because there are suddenly some clients who tend to abandon their investments when markets downturn, and many others hold uncertain views about the future right now. If there are any secrets to maintaining confidence in investing, could you share them with us?
Certainly. Well, I'd like to start off on behalf of our team thanking the investors for their support and their interest. It is something we take very seriously. It is something we are very grateful for and humbled by. Our message would be fairly simple, which is you have to have a long-term perspective. Yes. It is very hard to predict when markets will go up or when markets will go down. And so market timing is something that historically has been difficult to do and has cost investors a lot of performance. And psychologically, you have to do two things right. If you exit the market, that's one decision, but then you also have to be good on the other side, which is you have to get back into the market. And so in our view, what matters more is the time in the market rather than timing the market. So staying in the market over the long term tends to deliver better results for investors. And what that means is, as an investor, you have to be willing to ride out volatility. Markets will go up and down, and again, it's very hard to predict that. And the way you ride out volatility, I think, is by being diversified, but investing in portfolios that have very clear philosophies, processes, and objectives. And one of the things that we are very proud of is that we are very disciplined about our philosophy. It will not change. We are very convicted in it, even in good times or bad times. This is what the portfolio will stand for. And it makes a lot of economic sense. The notion that you're buying businesses that are profitable, that are reinvesting, you're trying to be disciplined about price. have been attributes that have generally contributed to longer-term success. So to any investor, we would tell them to stay the course, be diversified, and invest in products that are very clear about what they are looking for in businesses.
Thank you for your insightful and informative message for Japanese investors. Thank you again for having me today. That's all for this interview.
Thank you so much.
Thank you so much. Thank you.
Thank you.